Well, Dennis, you lead our international tax practice in Australia, and it's so nice to have a chance to see you again. I trust you're keeping well.
I am, thanks, Rod, and it looks like you're keeping well too.
I am. Thank you very much. So I wanted to catch up with you because I've heard about all the new Australian governmental proposals aimed at the taxation of multinationals investing in Australia. Tell me a bit more about those.
Thanks, Rod. Well, Australia continues to be at the forefront of supporting and implementing the OECD's BEPS action items, both through the first tranche of BEPS, which is the base erosion and profit shifting initiative, obviously, and obviously through BEPS, what we now call Pillar 2 and Pillar 1, so BEPS 2.0. Australia's been a very strong participant the whole way through, as evidenced by a number of Australian former politicians being part of the OECD as well. And so we had a recent change of government. After several years of a Liberal national coalition, we now have a Labor Party government. Part of their election platform was a number of potential measures to affect the taxation of multinational enterprises, as you said. And the critical ones there really were providing additional funding to extend and boost the Australian taxation office's audit and review programs. And that's been a very successful program for the ATO and seen as being a very good investment by the government in terms of the revenues that come out of that. The other one are a number of measures targeting multinationals, which include tax transparency requirements, a potential change to our thin capitalization provisions, as well as a firm and unambiguous intention to adopt the OECD's BEPS 2.0 programs, which firstly look obviously at a reallocation of taxable income amongst multinationals as Pillar 1, and also setting a global minimum tax under Pillar 2. So the new government has made a strong commitment that those implementation will occur with those rules. And then finally, there are changes proposed to tax treaties and the use of intellectual property under tax treaty regimes as well. Probably the most far-reaching of these, Rodney, is the proposed change to the thin capitalisation rules. So currently Australia has a asset-based safe harbour rule in addition to an arm's-length debt test, which is basically how much debt would a third-party lender provide to the entity based off its Australian assets, and a worldwide gearing test as well. The Australian Labor Party's proposal is to remove the safe harbour asset-based test and replace that with a 30% EBITDA test going forward from the 1st of July 2023. So that obviously is in line with the OECD's action items around thin capitalisation and limitation of interest deductions. This is proposed to have probably quite far-reaching impacts to a number of different industries, especially industries in the real estate sector, where oftentimes there can be quite a lot of volatility around the asset bases. So one of the things we're certainly seeing and being aware of is the need to sort of revisit some of those thin capitalisation positions people might have taken around their inbound debt gearing functions and see whether or not there needs to be a change to that, whether they need to start to adopt one of the alternate methodologies I mentioned, being either the arm's length debt test or the worldwide gearing test.
Really interesting, Dennis. And just that's a wide range of proposals.
Yes.
You're talking about tax transparency, attribution of income, limitation of interest expense, and you mentioned the real estate industry.
Yeah.
Are there any other industries that you're initially thinking might want to be paying close attention to these proposals?
Yeah, and look, I think, Rod, a number of those would be sort of similar to the real estate industry. Just to say, infrastructure investors would be another good example where naturally, it's been probably quite easy to undertake your safe harbour calculations based on your balance sheet and your assets on the balance sheet. Once again, if there's volatility in those EBITDA numbers, it'll be quite difficult maybe to prepare and plan for a long tail with the safe harbour you previously had. So I think infrastructure investors will be one. Other industries where there's potentially quite volatile earnings as well might be one in which you might need to sort of revisit whether arm's length debt test is more appropriate. So some of the technology sector industries as well, where you're sort of seeing maybe some sort of volatility in earnings might be one in which you need to revisit and see if there are other options available to you. And as I said, the safe harbour test is one which is well known in Australia, but does have a lot higher compliance costs. So generally speaking, there's a lot more work to be involved to assess how much a third-party lender would provide to you naturally. KPMG's got a lot of capability in that regard, but there often is a lot more work to be done each year in order to satisfy that test and show you've been able to sort of meet the requirements that would be put in place under the arm's arm's length debt test or the worldwide gearing test as well.
Got it. And it sounds like actually quite a lot of work if you're trying to forecast out earnings on a consolidated basis.
That's right.
So it may be early days, but just perhaps crystal ball gazing, what issues are you starting to see arise in practice today as a result of all of this?
Good question, Rod. I think, first of all, you have the planning for thin capitalisation, which I think is always important. Taxpayers need to understand what their sort of, gearing profile will look like. In terms of sort of the other measures, I mean, the ATO's ongoing sort of compliance focus is one that really is important for multinationals to be aware of. One of the areas in which we see a lot of that as international tax practitioners is through our hybrid mismatch rules. So Australia has implemented since 2019 the OECD's Action Item 2 around hybrid mismatches. We have a particularly sort of strongly enforced import and mismatch rule in which a vanilla payment from Australia, maybe completely non-hybrid, can still be sort of traced up a chain of payments essentially and can cause you a problem if you have a hybrid somewhere else in your group. So it's often a surprise to inbound investors when they hear that we need to understand really how the whole world operates, where are the hybrids anywhere within a global group, because the Australian Taxation Office has made it very clear through some of the public guidance, they will expect a multinational to be able to say positively that there are no hybrid mismatches elsewhere in the group that are imported into Australia. So one of the things that us inbound taxpayers really need to be aware of is planning ahead to comply with those requirements, having the documentation in place and respecting what the ATO has said in its public guidance around its expectations around the compliance steps that taxpayers will take to prove that they don't have an imported mismatch in Australia. This often comes as a bit of a surprise to inbound taxpayers, but it is something which we've seen the ATO in their reviews be very focused on and something they want us to be able to prove to them that we've considered this and spoken to stakeholders within the global group. So not just an Australian tax manager, but the global head of tax as well, for them to be able to say that they've had a look at their structure and they can say there are no hybrid mismatches that come into Australia. So I think, Rod, taking that into account, we do have a very vigilant and very well-resourced tax authority, which means that taxpayers need to be aware and need to be prepared for reviews that happen and sort of have their ducks in a row, so to speak, to sort of respond to questions that come up from the ATO.
And that's a really interesting compliance thing, because I can imagine it does catch people by surprise, because what I heard you saying is the ATO is asking you to look not just one step above the Australian subsidiary, but all the way up and across to understand what arrangements could effectively be relevant for Australian tax purposes. And they could be between two totally different countries, way remote from the Australian organisation.
That's right, Rod. So we look out a long way beyond our own boundaries, and you're absolutely right. I mean, at the end of the day, it often comes down to literally getting a group structure chart and seeing where we've got circles in boxes or triangles that are upside down anywhere in that global structure and understanding how that might affect Australia, because believe it or not, it can come back and have an impact back to your deductible payments in Australia.
That sounds like an amazing amount of work, or maybe amazing is the wrong word to use, but given something like that, so live issues you're starting to see under examination, to look at requiring a taxpayer to look around the structure, given the proposed changes to interest expense, attribution of income, what are you telling people to consider doing these days?
Look, I think the first thing, the most important thing is just be prepared. I think it's, understand what your tax affairs are, understand that these rules are coming in. They're quite clearly policy of the new government, so they'll be coming. And plan ahead, I think, because the thin capitalisation rules will come in from, as I said, the 1st of July 2023. The hybrid mismatch rules are already in place, and our compliant programs and our even tax return have a number of disclosures, so they can't be done at the last minute. You need to plan ahead for that. And then, of course, we've got on the horizon Pillar 2 as well. The global minimum tax is this amazing sort of change to the global tax architecture. And once again, there's a lot of planning involved in that naturally around sort of the data sources you need to draw on, understanding your business, and once again, getting back to the joy of tax vector counting. So I think all that comes back to one simple message, Rodney, which is be prepared, understand where the pressure points are in your business. And sort of obviously you can always reach out to us, because we are seeing these issues live now and sort of having experience in planning for all these different changes which we're seeing on the horizon.
Well, that's good advice and a good note to end on, Dennis. I mean, you've painted a picture of really meaningful tax proposals that could really impact multinationals. You've also painted a picture of a well-resourced ATO, very focused on the global picture of clients or taxpayers and the need to be prepared well in advance for that because it's coming. So a lot of work and certainly not the sort of stuff you want to leave till the day before. So thank you for your time.
My pleasure. Thanks, Rodney. Good to speak to you again.
Good to speak to you.